In this week's video, we'll review the latest charts to help us better understand the key to solving the present-day investment puzzle. We'll be moving quickly, so feel free to use the pause button on your video player. These are the major topics we'll be covering, and we'll get right into the first bullet point, the complexities of forecasting in 2023. If we objectively review the changes on the chart of the S&P 500, this chart is as of Friday, May 12th at 2:52 p.m. Eastern Time, relative to the look here in October of last year and the look in the present day. Probably fair to say the market's base case in recent months involves tame inflation, allowing the Fed to pause the rate hikes, which in turn will allow the economy to land in a relatively soft manner without a major hit to corporate earnings and employment. And if we objectively review that chart of the S&P 500, it's probably fair to say that many market participants take it a step further. Their base case is tame inflation, allowing the Fed to pivot. In the context of history and in the context of this video, a Fed pause is typically defined as a period where the Fed has been raising rates, they stop, and they don't do anything for 6 months. They don't raise rates and they don't cut rates. Contrast that with a Fed pivot. In the Fed pivot case, everything's the same. The Fed's been raising rates. They stop, and within that 6-month window, they cut rates. Thus, the even more ambitious base case involves tame inflation, allowing the Fed to pivot, meaning they'll be cutting rates sometime in the next 6 months, leading to the proverbial soft economic landing. Now, if you were to look at market action on Friday, May 12th, there's a lot of red on the screens today. It tells us it's probably prudent to keep an open mind about a scenario that involves sticky inflation or persistently high inflation, causing the Fed to raise rates sometime in the next 6 months, increasing the probability of a hard economic landing. Thus, we're beginning to see from a contingency planning and forecasting perspective, there's a lot of different scenarios to consider. And the reality is, this scenario, and this scenario hardly scratch the surface, which tells us even when we keep things fairly simple from an economic perspective, the probability of picking box A, box B, and box C accurately several months or a year in advance is difficult at best. Forecasting is always difficult, and even more so in May of 2023. And when we consider all of these permutations and combinations, it's not shocking that we've had some wild swings in economic data, wild swings in business conditions, and wild swings in interest rates, as well as wild swings in the markets. Thus, from a risk management perspective, it's not really prudent to plan for one base case. And in terms of the way things work in the real world, the scenarios shown on your screen really don't scratch the surface either. We could add in any number of variables out here, geopolitical, profit margins, etc. And as you might imagine, investment outcomes can be significantly different relative to how things unfold in the coming months. If we take this PIMCO analysis dated May 10th of this year, here, our analysis across 70 years in 14 developed markets indicates that increases in recession and unemployment have usually begun around 2 to 2.5 years after the start of the hiking cycle. In the present day, 2 to 2.5 years would take you to March of 2024, next year, all the way out to September of 2024, telling us it's possible this is the base case scenario in the coming months, but eventually it morphs into something different and quite a bit worse. And this is hard evidence of the concept that monetary policy works with a lag. It takes time for all of this to work its way through the economy. And in terms of the way these studies are usually conducted, if the Fed cut rates 4 months from today, that would be a pivot. They'd be cutting rates in the 6-month window. If they cut rates in 8 months, that would be a Fed pause. And you can see stock market performance, S&P 500, 10-year treasuries, is significantly different when we look at changing just one variable. And from a guidance perspective, the Fed has been telling the markets for quite some time that we're under a higher for longer scenario and that the bar to cut interest rates, that bar is extremely high as long as inflation remains elevated. How does that guidance match up with history, what the Fed has actually done? The answer is quite well. Bloomberg piece dated May 10th, 2023. Text in the lower left-hand corner of your screen. Goldman Sachs analyzed the Fed's behavior in the 6-month periods after the previous halts in hiking cycles and found that they rarely eased when labor markets were tight. Surprisingly, this mattered more than any shifts in inflation. Said another way, up here, upper right-hand corner of your screen. When Fed pauses have occurred against the backdrop of tight labor markets, the Fed has rarely eased in the subsequent 6 months. The most common outcome has been an on-hold Fed. Typically, the probability of the Fed cutting rates increased when the labor market became a problem. When the labor market was still strong, they tended to sit there over the 6-month period rather than cut rates in that 6-month window. Bloomberg story dated May 11th. A Fed pause now seems a good bet for the next month, but there's little reason to expect monetary easing anytime soon, and that aligns with the guidance provided by the Fed, higher for longer. And again, typically, if the Fed's going to cut, bad things have to happen economically. Bloomberg dated May 11th. We are starting to see some bad things happen. U.S. jobless claims jumped to the highest since October of 2021. We're not quite there yet, but if we continue to move in this direction, that would be concerning from a recession odds perspective. Inflation, still elevated. Starting to see some cracks in the labor market. If those cracks widen, then the odds of scenario 4 would increase and or the odds of scenario 11. And if it turns out the Fed is still in the picture due to elevated inflation, then the odds of additional problems related to the debt markets and banks, those odds will increase. Thus, with an almost infinite number of possible outcomes, it's important that we listen to the market and make some adjustments to our approach. And we have to respect that the drivers of inflation have changed. And when central banks went from easy money to ultra easy money to highly questionable easy money, it provided an incentive to take on debt. And given the complexity of the situation and the uncertainty in the marketplace, and the fact that the U.S. stock market remains within a very wide trading range and a more narrow trading range, if we take it day by day and listen to what the market has to say in an unbiased manner, we'll increase the probability of successfully navigating to the other side. We've covered this concept in the past. Credit markets, intermediate corporate bonds relative to 3 to 7 year treasuries. So this is a riskier and longer duration asset relative to a more conservative and shorter duration asset. And when we review this chart, especially in the context of dates, one thing jumps out. The market's tolerance for risk had the most abrupt change in 2023, walking forward from February 2nd. So this risk-on ratio peaks on February 2nd. And you may remember on February 3rd, that's when we had the well above expectations NFP report. And what did that do? Well, inflation expectations and Fed expectations in here were relatively muted. The market was expecting inflation to be sitting somewhere today in the 3.5% range rather than the closer to 5% range that we have in May of 2023. And it's also noteworthy that this report and this shift in expectations really had a bigger impact on this chart than the regional banking issues. So maximum fear in recent weeks and months comes here on March 13th. Silicon Valley Bank failed after the close on Friday, March 10th. And then the Fed announced all the special facilities on Sunday evening, March 12th. What's relevant about this chart is the credit markets are not nearly as confident as the stock market. During the trading session on May 12th, this ratio was sitting closer to maximum 2023 fear, which is here in March, relative to maximum confidence that came on February 2nd. Said another way, the ratio is way down here today. In February, it was up here. Contrast that with the S&P 500 that's sitting much, much closer to maximum economic confidence. Here we are today. Here's the February high. And we're nowhere near that maximum fear down here on March 13th. So there's a divergence relative to the views in the stock market and in the credit market. And from a risk management perspective, this chart is looking more vulnerable, but it hasn't broken down yet. We haven't exceeded this low here from March, nor have we exceeded the low from December of 2022 in here. And if we did that, concerns would increase. Right now, this ratio is trying to make a stand on Friday, May 12th, near the 250-day and 200-day moving averages. And there's another way we can monitor this, using anchored volume weighted average price. Again, this ratio is closer to the concerning end of the spectrum relative to the confident end of the spectrum. We're still holding the line from the October low. You can see acted as support here, here, here. It's trying to act as support on Friday, May 12th. So for now, this ratio is in a range, and as long as it stays in the range, try to remain patient. Why? This was fear down here, and the market rebounded in here. Not making any assumptions about what happens, but this is an important point here. This line comes from the October low. We're holding just above it during Friday's session. The purple line is tied to basically maximum confidence right before the markets peaked in late 2021 and early 2022. Price is right in between those lines. We'll learn something either way. In here, relative to this one input, because we're using a weight of the evidence approach, you're in do less territory in the range. If we break down and move in this direction, the probability of getting even more defensive would increase, but right now we're in a range. We also have to remember when we're looking at the bond market, especially when you're looking at treasury bonds, we don't know how much of a skew we have relative to the debt ceiling. So once again, confidence in this ratio is much lower today relative to where it was in February of this year. So here's the ratio in the credit market on February 2nd, and here's March 13th. If we look at the anchored VWAPs during Friday's session, May 12th, the S&P is much, much closer, and this is price, the black line, to the February level relative to the March 13th level. Again, a divergence between the two charts. And the divergence can be resolved in any number of ways. This chart can deteriorate, or this chart can improve. So forget all the colored lines, just look at price. During Friday's session on May 12th, we're in a very short-term range in here. Try to be patient. We're still within this intermediate term range between this point and this point, and we're still trading here between the much wider range tied to the August 2022 high and the October low. Thus far, price is consolidating in what is still a constructive area, but a vulnerable area. Concerns would increase if we get down here, even more so if we close below this level, and even more so if we take out the December low. But we're not anywhere near this level or this level during Friday's session. How about the ratio of tech stocks XLK relative to 3 to 7 year treasuries? And as we mentioned last week, if the market thought earnings in the tech industry were about to get whacked, and the Fed was going to pivot sometime in the next 6 months, and the market was extremely confident about both of those outcomes, we really wouldn't expect this chart to look like this. Under that scenario, where earnings get whacked and we go into a horrible recession, again thinking extremes from last week, we would expect IEI, a more defensive asset, to outperform XLK. Well, that's not really what we have during the session on May 12th. Very similar scenario. We're still consolidating in terms of the anchored volume weighted average price line, speaks to cost basis. Above the colored lines, buyers tend to be in control. It's easier to be patient. If we move into this area here, the longer we stay there, the more concerning it would become. These lines are tied to the COVID low. Be even more concerning if we move here. XLK in isolation during Friday's session still looks like buyers are in control. And relative to these possible scenarios, when we look at this ratio of the S&P 500 relative to 3 to 7 year treasuries, it's very, very difficult to say the market is confident about any scenario at this point. That's why we're in a range. And since investment outcomes are significantly different relative to how things play out in the next 6 to 12 months, it's not surprising that we've seen some wild swings and a lot of volatility, but we're still in a range, still indecisive. Relative to the cost basis, same ratio. This is SPY divided by IEI. Still has a buyers remain in control look. Very, very similar situation when we look at SPY in isolation at 2:07 p.m. Eastern Time on May 12th. S&P was down approximately 28 points. Very similar situation with the broader S&P 1500 relative to the cost basis lines. Possibly a little more vulnerable, but this is all possible support down here. October low, price makes a stand near a logical area. March low, price makes a stand near a logical area. Nothing alarming yet here. Equal weight S&P 500 in isolation, RSP here, a little more concerning and a little more vulnerable. I remember last year when the market was extremely concerned about inflation, the Fed, and rate increases. Stocks and bonds got whacked last year, so this is the type of look from 2022 if that's the scenario. SPY is falling and IEI is falling. We already know SPY in isolation still looks okay. And the same can be said for IEI. Here's the October low, higher low, and eventually this is a higher high relative to this high. But it's noteworthy from a guidance perspective. On May 9th here, and again on May 12th, the Fed came out and said, we haven't said we're done raising rates yet, and we don't see any reason to cut rates this year. This is IEI, 3 to 7 year treasuries in isolation here. Similar situation, not as confident with IEF 7 to 10 year treasuries, but still in the buyers are in control range. A little more concerning here when we look at RSP, the equal weight S&P 500 relative to IEI, telling us to keep an open mind about this chart eventually moving into this area here. That may happen. It hasn't happened yet. Thus, if we're willing to look at these charts objectively and we're willing to think, the markets can help us weed out some of these possibilities. And in the long run, the market's going to zero in on the actual outcome. That's just the way it works. Similar concepts here. May 4th, charts basically telling us the market believes the Fed is either finished or closer to being finished. No major change when we look at the same ratio on May 12th. And remember last week, again, chart dated May 4th here, we said this hesitation here probably told us something about inflation and Fed expectations. Market participants are very, very confident that inflation is not a problem and the Fed is finished. We would expect this ratio to move into this area here. How does it look today? Really no significant change. It's not really tipping its hand either way yet. Hard to say that it looks like maximum fear of the Fed rates or inflation because that's what this looks like over here. This is risk on here after the June low. And this is risk on after the October low. And since Q4 of last year, we've been in a range. So we should learn something if this ratio moves out here or drops down here. And in all cases, longer below, the more relevant it becomes. This range is relatively wide. It goes from here to here, and then the wider range goes from here to here. May 4th, riskier high-yield bonds relative to more conservative IEI. Said last week we were clearly in that same type of range. During the session on May 12th, still an indecisive range-bound look. But you can see this. Confidence has deteriorated fairly significantly on this chart relative to the banking issues. It's a ratio that we've covered in past videos, SPIB relative to IEI in the ETF world intermediate term corporates versus 3 to 7 year treasuries. For the most part here, you're talking about going out further relative to default probabilities, not a lot of difference relative to duration. This was a look at the chart here on May 4th, and much like the chart of the S&P 500, nothing really definitive here either. This is the lowest point in November and December of last year. This is the March low here. Concerns would increase if we moved into this area here, but that's not where we are during the session on May 12th. And if we were to draw a trend line from here to here to here to here, for the most part, the uptrend off of this low in July of last year is still intact. And just to show an example of how this can be helpful, SPIB relative to IEI. It's a major S&P 500 low here on March 9th of 2009. The lines show the performance of the two investments walking forward, with the riskier one in red and the more conservative Treasury ETF in blue. So for now, we have somewhat of a vulnerable but still intact risk-on trend. And the ratio is looking more vulnerable here, but for the most part holding these levels that are relevant. As stated earlier, some portions of the credit markets look a little bit more concerned relative to the stock market. Is there anything else that can help us keep an open mind about a wide range of outcomes, including much worse than expected outcomes? We're in a range, so it's reasonable to think about and plan for a break to the upside, a break to the downside, or continued sideways movement. This is NASDAQ, new highs, new lows. We've covered this many, many times. Has not improved yet. This is as of Thursday's close. This is the major low in the S&P 500 in 2002, 2003. This is what the data set looks like. March 9th, 2009, this is what the data set looks like. After a low in 2010, and right before a strong rally in 2012, the data set improves. It improves after the final low in 2016. And notice, it did not improve materially here in 2015 on the first low. Saw some improvement here. This still looks better than this. Christmas Eve low 2018, and significant improvement after the COVID low. If good things are going to happen, and they're going to happen for a long period of time, this data set for the most part has to improve. No major shift here. We still have improving momentum. Same basic message here. And you can make an argument that the NASDAQ is coming back to the very long-term trend dating back to 1978 here. Market made a stand here, 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 momentarily here, here, and again here. So far, so good. Momentum turning up. 2009, 2001. Market doesn't bottom here until October of 2002. This is during Thursday's session. Hard to say anything other than this is a constructive look. Still no definitive move on weekly RSI. JNK monthly, a proxy. This is a mutual fund, a Vanguard fund here. This is the 50-month moving average. This is near the major low in 2002, near the major low in 2009, stalled, trying to make a stand in the same general area. Notice, after the low, this is a convincing move away. A convincing move away. Not particularly convincing yet. You can see weekly momentum here is slowing, still indecisive here relative to price. If you're a stock market bull, you'd really like to see the ratio move away from the 30-week moving average. And pause your video player. When momentum gets this weak and turns up, typically good things happen. And that's a pretty convincing move here. It's a NASDAQ 100 relative to gold. This is the COVID low here. Made a stand in a similar area here. The longer it holds, the more relevant it becomes. We also have the reference point of the upward sloping 200-week moving average in red. But again, notice here, risk on is convincing. Don't really have a convincing look yet. QQQ relative to SPY. This neckline slopes upward. That's a good look. RSP relative to IEF looked a lot better in February of this year relative to where it was on May 11th at the close. If we drew a similar line for the S&P 500, SPY has been holding above this downward sloping trend line from the bear market. Not the case for RSP, but still, like many markets, still in a range here, but starting to push up and challenge the trend line from the October low. I would say more importantly, if RSP takes out the December low here and or this March low, moving into this area, concerns would increase. As always, longer below, the more meaningful it would become. See, we're below here relative to here, but we don't stay there for very long. This is after the major low in 2009, very similar and constructive look in Q4 of last year into early February of this year, RSP relative to SPY. Not nearly as constructive today, but stock market did well in 2017, so it's not necessarily a showstopper in the short to intermediate term. Nothing really definitive here either way, but the present look of this ratio, SP low volatility divided by SPY with the 200-day moving average, has more of a risk-off look, S&P 500, than what we had in February, late January of this year, but still hanging around in an indecisive manner. The markets are in a range, so we shouldn't be surprised to see somewhat of a mixed bag on these charts. SP low volatility divided by SPY looks a lot more bullish for the stock market. SPY divided by IEF, this is the very confident look on February 16th, the weekly cloud. Not as confident today, but still holding above the cloud this week. Still a constructive look relative to global stocks ex-USA. This is something to keep an eye on here. Momentum is deteriorating on this ratio chart. This is basically SPY divided by TLT. All things being equal, that's not a good look. Here's your risk-off look here. Unlike the S&P 500 relative to IEF, VGK still looks a lot better and a lot more confident and has it exceeded this 2022 high here. So relative to all these scenarios, it's very, very difficult to look at the chart of the total stock market relative to IEI or 3 to 7 year treasuries and say the market has really tipped its hand one way or another yet. Worth keeping an eye on. Is it possible that the stock market continues to go up with weak market breadth being led by mega caps? Of course it's possible. Wouldn't be the healthiest of moves, but it's possible. XLC, left shoulder, head, right shoulder, potentially neckline. Top holdings in XLC, Meta, Alphabet, Netflix, all mega, all important. From a credit and the ability to roll over debt perspective, XLF concerning. XLF weekly had a nice look like many charts in Q1 of this year. Looks a lot worse today, even from a momentum perspective. Don't really have anything yet from KRE, the regional bank ETF here. From a volume on price perspective, it is hanging out in an important area. And it does have DeMark 913s telling us it's possible this trend is exhausted. But price has to respond, something that hasn't happened yet. You can pause your video player and read this and compare to this. In its present form, this is a constructive bounce at the 50-month moving average. It's important that we don't get stuck on any one particular story. We've got range after range after range telling us that market participants really haven't zeroed in on any particular scenario with any level of confidence. And what are the key takeaways this week? It's very, very important that we respect we're living in a different world. 2 or 3 years ago, we had extremely high debt, but we had very, very reasonable interest rates. Now, we have even more debt, and we have interest rate pressure to the upside, and inflation pressure to the upside. A few years ago, we had friendly central banks. Now, not particularly friendly. So under our approach, when we see range after range after range, we try to do less, not more. And that may mean letting our account swing within those ranges. The charts we've covered this week won't stay in ranges forever. At some point, something has to change. We're either going to see an increase in bullish conviction, something we haven't seen yet, or the charts are going to break down and they're going to drop out of the ranges, and eventually there's going to be much better opportunities somewhere down the road, which means it's extremely important that we balance risk and reward. Don't want to be taking too much risk in this environment. We want to be taking risk that's in line with the weight of the evidence. And the weight of the evidence says things have improved considerably since the October low, but they've been stalled for several weeks. So rather than try to predict, we want to continue to listen to the market in an unbiased manner and do what we always do. Formulate some type of hypothesis and continually test it by asking, does the data set or chart align with or contradict that hypothesis? If it contradicts the hypothesis, we need to develop a new hypothesis. It's a difficult environment, but that statement applies to all market participants. And thus, under our approach, this type of market requires extra focus and extra effort. The backup quarterback analogy is a good analogy. The backup quarterback in the NFL has to study the playbook, they have to practice hard, and they have to be ready. When the starter goes down and they get their chance to run on the field, they have to be prepared. They have to be prepared to perform. The same is true for range-bound markets. Regardless of whether this market breaks to the upside or the downside, we have to consistently prepare because we don't know when the opportunities are going to present themselves. So right now, less is more. When in doubt, don't do anything. And our objective is to get to the other side. And that applies if the other side looks like this up here, right here, or it looks more like this here. And this bullet point here is why we're not all in. And now, more than ever, we all know the only way that any of this is going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.